What happens in underwriting? Underwriting is a crucial component of the mortgage process that dictates whether or not you'll actually get a final loan approval. Hi, this is Parker Couch with Homestar Financial, and in this video, I'm going to share what happens when your home loan is underwritten. Let's dive in and learn more about underwriting and how it actually works. What is underwriting? Okay, so underwriting is the process by which your lender, like me, verifies your income, assets, debt, and property details in order to issue a final approval on your loan application. Underwriting happens behind the scenes, and your lender might ask for additional documents and answers, such as where bank deposits came from, or ask you to provide proof of additional assets. But what does an underwriter actually do? Well, a mortgage underwriter takes a look at your finances and assesses how much of a risk a lender will take on if they decide to give you a loan. Makes sense, right? The underwriter, it helps the mortgage lender decide whether or not you'll get approval on your loan. The underwriter will ensure that you don't close on a mortgage that you can't afford. And if you don't qualify, the mortgage underwriter can actually deny the loan. So how long does underwriting actually take? Well, your mortgage can be just as unique as your financial situation. So the exact amount of time underwriting takes will vary on a case-by-case basis. The sooner that you get all of the necessary documentation to your loan originator or processor, that's the sooner your loan can actually be underwritten. So it is so important to get all requested documentation to the lender in a timely manner. But what makes up the mortgage underwriting process, you might ask? All right, so the underwriter evaluates your finances and past credit decisions. During the underwriting process, your underwriter looks at 4 key areas that can give them a more complete picture of you. First area is income. Your underwriter needs to know that you have enough income to actually cover your mortgage payments every single month. To prove this, you need to provide 3 types of documents to verify your income: W-2s from the last 2 years, your 2 most recent bank statements, and your 2 most recent pay stubs. Are you self-employed, or do you own a sizable share in a business? You'll also need to furnish then a few different documents in lieu of W-2s. Profit and loss sheets, K-1s, balance sheets, and your personal and business tax returns. Your underwriter will also check that your income matches the income that you report and verify your employment situation with your employer. Now we go to the appraisal. Appraisals are almost always required when you purchase a home. They provide protection for both you and your lender because they ensure you only borrow what the home is actually worth. An appraiser will inspect the property and walk through the home to take pictures and measurements in order to evaluate the actual condition and features of the home. The appraiser compares similar properties by looking for homes that are similar in location, size, and features. These comps need to have sold within the past 6 months and be within a mile of the property unless you live in, let's say, like a very rural area. Next, we have credit. An underwriter is going to also evaluate your credit score. Now, your credit score shows the underwriter how responsible you are when you pay back debt. A good credit score shows that you pay back your debts on time and also helps you qualify for a lower interest rate. The minimum credit score you'll need to have depends on the type of loan that you're applying for. The underwriter is going to look at your income, what you owe, and what you want to borrow to determine your debt to income ratio, DTI. That's what my shirt is. And your DTI is the total amount of money that you spend on bills and expenses each month divided by your monthly gross. It's pre-tax income. Lenders prefer to see a DTI ratio at or below 50%. Next, we have asset information. Your assets can help you get a mortgage approval because they can be sold for cash if you default on your payments. An underwriter might view your checking and your savings accounts, your real estate ownings, your stocks, maybe even personal property. The bottom line, underwriting, it just means that your lender is verifying your income, assets, debt, and property details in order to issue that final approval for your loan. An underwriter is a financial expert who takes a look at your finances and assesses how much risk a lender will take on if they decide to actually give you a loan. Throughout the entire underwriting process, it is a really good idea to actively respond to your lender's request. Do not apply for any new credit lines during underwriting, and please respond to inquiries as quickly as possible. Be upfront and honest about your finances, or this will cause delays in the loan application process. And of course, we are here to help along this entire journey. This is Parker Couch with Homestar Financial. Is there anything I can do to help? Give me a call or a text at 770-540-4936 or email me at parker.couch@homestarfc.com. Thanks so much for watching.